morning, everyone. Good morning, sir. Those who are present today. I'm Raktim Sarkar, and I am from Brunei University, currently doing internship in ICAPITAL Academy. And today's my presentation topic is corporate finance. And this is my consent note. I hereby grant permission to iCapital Academy and Corporate Advisory LLP to use the video presentation, assessment test, and the MCQs created and provided by me for educational and promotional purposes. This includes publishing or sharing the content on their social media platforms, website, or through any other medium they deem appropriate. I confirm that I have no objection to such use. Before delve into the core topic, first of all, we have to know what is corporate finance. Corporate finance is a vital pillar of every successful business. This is a branch of finance that deals with the funding, capital structuring, and the investment decision. And the ultimate goal of the corporate finance is to maximize the shareholders' wealth. Importance of corporate finance. Why it is very much important for the business? Because it's the engine behind business expansion, smart investment decision, and effective risk management. Every financial move, from the launching a new product to acquiring another company, corporate finance is the base model. So, uh, in the next slide, objective of corporate finance. Objective of corporate finance is to resolve the uh, four main pillars, that is profit maximization, wealth maximization, ensuring liquidity, and maintaining an optimal capital structure. These objectives guide every financial decision, ensuring that the company remains profitable, solvent, and strategically positioned in the market. Okay. So next is a function of corporate finance. Corporate finance performs several critical functions. It involves financial planning and forecasting, raising funds from the diverse sources, and making investment and dividend decision, and managing financial risk. This function work together to ensure that the company financial health remains strong and sustainable. Coming up to the next slide, financial decision in corporate finance. There are four major financial decisions in corporate finance: investment decision, financial decision, dividend decision, and working capital management. Each decision play a unique role in shaping company's financial strategy. Together, they form the backbone of the corporate finance management. Next, role of financial manager. The financial manager is the captain of the financial ship. Their responsibilities include financial analysis and planning, fund and investment management, risk mitigation, and ensuring compliance and regulations, government regulations. A skilled finance manager not only safeguard the company's assets, but also drives the growth of the company. Agency problem in corporate finance. So what is agency problem? Agency problem is the major challenge in corporate finance. It means a conflict between management and the shareholder. It is called agency problem. Sometimes manager may pursue personal goals that don't align with their shareholder interest. This can be mitigated through incentives, monitoring, and strong corporate governance practices. Financial environment in the corporate finance. Corporate finance does not operate in isolation. It's influenced by broader financial environment, which includes financial markets, financial institutions, regulatory bodies like SEBI and the RBI, and economic environment. So, affecting interest, inflation, and investment opportunities, it is influenced by the financial environment. Introduction to TVM. TVM stands for total time value of money. It's the most fundamental concept in in finance. So simply, it states that a rupee today is worth more than the same rupee tomorrow. Like today, I have the money is worth more than the money we have in future. So value of the money is decreased in the future. And why this is happened? Why it is happened? Because of its earning potential and the impact of inflation. This This principle is foundation for evaluating investment loans and financial planning. Importance of TVM. So TVM is not just a theory; it's a practical thing. Okay, so it helps us to evaluate investment options where we have to invest, or calculate EMIs plans for retirement, and make capital budgeting decisions. Next, future value concept. Future value tells us how much investment made today will grow over time. And as you can see, this is the formula of the future value. So going up to the next slide, present value concept. Present value helps us to determine the worth of the future cash flows today. Using the formula, this is the mention here, this is mentioned here, we can assess whether an investment is worth making or not. Perpetuities and annuities. So an annuity involves equal payment at a regular intervals like SIP. Okay. And a perpetuity, on the other hand, provides payment forever, such as a perpetual bond. Okay. This concept helps us to evaluate long-term cash flow and financial products. Computing versus discounting. Compu- Compounding is about growing money into future, while discounting brings future money back to the today's value. These two technical terms, compounding and discounting, are used in finance, and these are the backbone of the investment analysis and financial planning. Effective versus nominal interest rate. A nominal rate is started annual rate, but the effective rate considers compounding. For example, if interest rate compounding quarterly means after 3 months, so the effective rate will be higher. So understanding this helps us to compare financial products accurately. Then coming up to next slide, multi-period compounding. When an investment span multiple periods, we use multi-period compounding. And the formula of calculating multi-period compounding, it is mentioned here. And this helps us to calculate long-term returns. Especially, it is useful for retirement and educational planning. Then application of TVM in corporate finance. TVM is everywhere in corporate finance, from capital budgeting and lease decision to valuing stock and bonds. Everywhere this is present. It's also crucial for retirement and fund calculation. Practical example of future value calculation. So let's say we invest 10,000 at 10% for 2 years. Using the formula, this the future value becomes 12,100. This simple example shows that how compounding works and helps us to compare investment options. Practical example of present value. So suppose we expect 50,000, 15,000 in 3 years, and the discount is 8%. The present value is calculated 11,905. This tells us what that future amount is worth today. It helps us to decide if investment is worthable or not. Introduction to capital budgeting. Capital budgeting is the process of evaluating long-term investment opportunities. It helps companies to decide which products, which project to pursue, whether it is a project one or whether it is a project two, three, four. Okay, so or whether it's launching a new product or expanding the operations, acquiring assets or acquiring any company. So capital budgeting helps those decisions. Importance of capital budgeting. Why is capital budgeting so important? So because it is involves allocating large sums of money to projects that have long-term consequences. These decisions are often irreversible and carry significant risk. Capital budgeting process. So the process begins with capital budgeting process. It begins with the identifying the investment opportunities. Then we have to evaluate them using financial techniques like NPV, means net present value, and IRR. IRR full form is the internal rate of return. After selecting the best projects, we implement that, and then we monitor them. Types of capital budgeting. There are various types of capital budgeting decisions. Expansion project helps business. Replacement. Replacement decision improve efficiency. R&D means research and development investment drive innovation. And strategic investment ally with the long-term goals. These are the types of capital budgeting decision. Then technique of capital budgeting. To evaluate projects, we use several techniques like payback period, NPV, net present value, IRR, internal rate of return, PI, profitability index, and ARR, counting rate of return. Payback period method. The payback period method calculates how long it takes to recover the initial investment. It's simple use for liquidity analysis. Okay. Payback period example. For example, if we invest 50,000 and receive 12,500 annually, the payback period is 4 years. Because 4 into 12,500 is equals to 50,000. So 4 years is the payback period. NPV. NPV is one of the most reliable method. It calculates the present value of cash flows in present value. If NPV is positive, the project adds value. And if the NPV is negative, then it should not add any value. NPV calculation example. Let's say we invest 60,000 and expect 20,000 annually for the 4 years at a 10% rate. So after putting the NPV formula, it gives that we calculate the present value in the form of cash inflow and subtract the initial investment. Then, if we have the positive NPV, then we should invest in that case. IRR, internal rate of return, is the rate at which NPV becomes zero. Means it's useful for comparing projects and checking returns exceed the cost of capital or not. Advantage of NPV method. NPV has several advantages. Considers the PVM, it measures absolute profitability and it includes all cash inflows. Limitation of NPV. However, NPV requires accurate cash flow estimation and is sensitive to change in the discount rate. So this is a very much create boundary for the NPV method. Advantage of IRR method. IRR is very easy to use and interpret because it include percentage return and it's also considered the TVM. So these are the advantages of IRR. Limitation, but IRR has its limitation. Non-conventional projects can produce multiple IRRs. So it assumes reinvest at the IRR rate, which may not be realistic. And sometimes it can conflict between the NPV ranking. Coming is the profitability index. So, for instance, or giving an example, if present value of inflows is 1,20,000 and outflow is 1 lakh, then the PI is 1.20. This means this is a greater than 1. So this can be accepted project. PI example, profitability. Uh, this is all I given. ARR. If we invest 80,000 and uh, the average annual profit is 16,000, then ARR is 20%. Okay, and ARR is average annual accounting profit divided by initial investment multiplied by 100. Thus, ARR can be calculated. And one of the major challenges is it ignores TVM, time value of money. Risk analysis in capital budgeting. Even the best investment plans carry risk. So that is why risk analysis is critical part of the capital budgeting. It helps us understand how changes is assumptions, how changes in assumptions like cost, revenue, or market condition. Sensitivity analysis. So this is a method which tests how changes is one variable, say sales volume or cost, impact the project's NPV or IRR. It helps us to identify which factors are more sensible and require for close monitoring. Scenario analysis. Scenario analysis goes a step further. Okay, so it considers multiple outcomes, best case, worst case, or most likely case. So these are a broader view of potential risk and rewards. Break-even analysis. BE analysis or break-even analysis tells us the point where the total revenue exactly equals to total cost of the capital budgeting. It's the minimum level of output needed to avoid loss. Decision tree analysis. Decision tree analysis is a graphical method that maps out sequential decision and their possible outcomes. It's useful when the projects involve multiple stages or decision points. By visualizing each path, we can evaluate risk or rewards more clearly. Capital rationing. So sometimes company face capital rationing. So what is that? Where the funds are limited and not all profitable projects can be pursued. Maybe there are more than one or two projects that can be profitable if we invest in that project. So, but the thing is, we don't have much amount of money to invest that profitable projects. So, this is capital rationing. We prioritize projects using tools like NPB and PI. So, then we can decide which one is most profitable. Then the money we have By that, we pursue that project only. Introduction to cost of capital. Cost of capital is the minimum return a company must earn to justify an investment. It's the benchmark is to accept or reject the project. If a project does not meet this threshold, it's not worth the risk. This concept includes the cost of debt, equity, and cost of preference capital. Importance of cost of capital. Why cost of capital is so important? Because it is it helps us to evaluate project, decide on capital structure, guide dividend policy, and even value the firm. It's the foundation for strategic financial planning and ensure that resources are allocated efficiently. Factors affecting cost of capital. Several factors influences the cost of capital, like market condition, the company's risk profile, and the capital structure mix. Capital structure mean ratio between the debt and the equity, dividend policy, and tax rate. Now, coming up to next, cost of debt or KD. Cost of debt is the effective rate a company pays on its borrowings. After accounting for tax benefits, the formula becomes KD equals to interest multiplied by 1 minus tax rate divided by net proceeds. Cost of preference share or KP. Preference share have a mixed dividend, or sorry, it's fixed dividend, and their cost is calculated as KP equals to preference dividend divided by net proceeds. The dividend are not tax deductible. This is a very major thing. It's not tax deductible. Cost of equity. Cost of equity reflects the return expected by the shareholders as they invested in the shares of the company. It can be calculated using the dividend discount model, like K equals to D1 divided by P0. Uh, as this is a maybe a Gordon's model. It can also calculate as CAPM model, and it reflects shareholders' required return. WACC, weighted average cost of capital. WACC is the average cost of capital source. This weighted by their proportion in the capital structure. So this is the formula mentioned here. This is the formula of WACC, weighted by the proportion of each source of capital. This is a practical math that I have included in my slide. Uh, this so that a company has 5,000 in their equity at 12% and 3 lakh in debt at 8% with a 30% tax rate, and 2 lakh in preference shares at 10% rate. So we calculate the WACC, and this is the formula for WACC calculation. You can calculate by yourself. Significance of WACC in decision making. WACC serves as a benchmark for project evaluation. If a project returns exceed the WACC, it adds value. It's also used in discounting cash flow, like DCF, valuation and guidance for financial strategies. Marginal cost of capital. Marginal cost of capital is the cost of raising one addition unit capital. It's a crucial for expansion decision and often increases as more capital is raised. Companies must monitor it to avoid eroding returns. Optimal capital structure. Optimal capital structure is the mix of debt and equity that minimizes the WACC, weighted average cost of capital, and maximize the firm's value. It balances the risk and the return at the same level and ensures the financial stability and investor confidence. Factors influencing capital structure. Several factors are influence the capital structure. Businesses risk, company size, market condition, growth rate, and tax benefit. These are the factors that majorly influence the capital structure of any company in long-term solvency and strategic flexibility. Capital structure is structure theories. On the basis of capital structure, there are multiple theories. So first one is net income approach, then net operating income approach, then hypothesis, then traditional approach. First one is net income approach. It states that more debt lowers the WACC and increase the value of the firm. Then NOI, net operating income approach. Uh, it states that capital structure does not affect the value of the firm. Modigliani and Miller hypothesis, hypothesis. These concepts states that in perfect matters, structure is irrelevant, but with taxes, dates, it can add value. These all are the irrelevant theories. And this is relevant theory, that is traditional approach. Uh, it is not mentioned in the slide, and they are an optimal mix of balance, cost and risk. This is called traditional approach. Then comes to the next slide, introduction to leverage. Leverage refers to the use of fixed cost, either operational or financial. So magnifying returns, it's a double-edged sword. Okay. While it can boost profit, it also increases the risk. So either you can maximize your profit or either you can maximize your risk. So there are three type of leverage: operating leverage, financial leverage, and both combination. That is called combined leverage. Next comes DOL or operating leverage. Operating leverage arises from fixed operating cost. It measures how a change in sales affects the EBIT. EBIT means earning before interest and tax. The formula of calculation operating leverage is percentage change in EBIT divided by percentage change in sales. Operating leverage example. For example, if sales increases by 10% and EBIT rises by 20%, the operating leverage is true. This tells us that the company's earnings are highly sensitive to sales fluctuations. High operating leverage is common in industries with high fixed cost, like manufacturing. DFL, financial leverage. So, financial leverage results from fixed financial cost, such as interest on debt. It measures how changes in EBIT affects the EPS, earning per share. EPS full form is earning per share. The formula of financial leverage is percentage change in EPS divided by percentage change in EBIT. A high financial leverage means that small changes in operating income can significantly impact the shareholders' return, but it also increases the financial risk. Financial leverage example, here I have put a example of financial leverage. Let's say EBIT is 15% and EPS is rises by 30%. The financial leverage or DFL is 2. Okay. This shows that the company is using debt efficiently to boost shareholder returns, but it must manage its interest obligation carefully. Combined leverage. Combined leverage is the product of operating and financial leverage. Means DCL equal to DOL multiplied by DFL. It reflects the total risk exposure from both fixed operating and financial costs. A high DCL means a high DCL means companies' earnings are highly volatile, and even small changes in the sales can have a big impact on EPS. Leverage summary table. Here I have put one table, as you can see, guys. This table summarizes the three types of leverage and their implications. Operating leverage affects in EBIT, financial leverage affects EPS, and combined leverage affects both EPS and EBIT. Together, they help us to understand how a company cost structure influences its profitability and risk. EBIT, EPS analysis. EBIT EPS analysis helps companies choose between financial options, debt or equity. It shows how different level of EBIT affects EPS under each options. This analysis is crucial for making informed financial decisions. EBIT EPS crossover point. The crossover point is where EPS from two financial plans, say debt and equity, are equal. Debt and equity are equal. Below this point, equity financial may be better. Above this point, debt financial could be better and it may offer higher returns. These tools determine the best strategy for uh, investment based on expected earning. Okay, then comes introduction to dividend decisions. Dividend decision resolve around simple it is resolved around simple yet powerful question. Should the company distribute its profits to shareholders or reinvest them back into the business? This is tricky question. Should a company distribute its profit to the shareholders as a dividend form or reinvest them back to the business as the return earnings? So these decisions impact investor satisfaction, firm's growth, and market perception. Ultimately, they are a part of broader goal of maximization of shareholder wealth. Types of dividends. There are multiple dividends present. Cash dividend, stock dividend, property dividend, liquidity dividend, and interim and final dividend. So cash dividend. So cash dividend. These dividend are most common direct payout to the shareholders. Stock dividends or bonus shares increase the shareholders' wealth as cash outflows. Property dividends. It involves the non-cash assets. Liquidation dividends. It returns the capital during the winding down. And finally, the final dividend or interim dividend. It reflects the timing, mid-year versus 1 year. So each type serves different strategic purposes. It can calculate quarterly, mid-yearly, and annually. Dividend policy. Dividend policy defines how and when dividend are paid. A stable dividend policy offers consistency. Okay. Then comes constant payout ratio. A constant payout ratio links the dividend to profit. So it links the dividend and profit. Then come residual dividend policy. Residual dividend policy pays dividends only after funding investments. So next come hybrid policy. A hybrid policy blends stability with flexibility. Okay, so these are the dividend policies. So choosing the right policy depends on the company's financial goal and investor expectation. Because ultimately, their goal is to maximize the shareholders' wealth, right? So coming up to the next slide, factors affecting dividend policy. There are several factors present who influence the dividend decision: liquidity position, earning stability, debt obligation, tax consideration, and shareholders expectations. The company's liquidity position can it afford to pay? So it affect the dividend. It, earning stability are profit consistent? No, right? Debt obligation, does it need to prioritize the repayments or not? So these are the all factors that affects the dividend policy. Then comes the relevance theory of dividend decision. First come the relevance theory. So Walter's model and Gordon's model. So they suggest that the dividend decision can be influence investor perception and stock price. So let's explore it more in depth. Walter's model first. Walter's model says dividends are relevant and its relevance depends on the relationship between the return on investment ROI and cost of capital K. So if R is greater than K, then it's retain earning. Firm should retain earnings. And in case R is less than the K, it should distribute its dividends to the shareholders. Then comes Gordon model. Gordon's growth model values a firm based on the present value of expected dividends. It assumes a constant growth rate and suggests that stable dividends increase investor confidence and firm's value. It's widely used in model in equity valuation. Okay, these two are relevant theory. Now comes irrelevant theory or irrelevance theory. On the other hand, this Modigliani-Miller theory argue that dividend policy does not affect the firm value, assuming perfect markets. No taxes, no transaction costs, or no other variable cost. According to their hypothesis, what matters is the firm's earning. This is the thing that all matters, according to the Modigliani and Miller. So it is all matters. Now, coming up to the next slide is real world dividend policy example. Here we explore the real world example on the ground basis, not any hypothetical example. So first case, in case of Infosys is known for its consistent dividend, as you can know, guys, which builds investor trust. Reliance. Reliance, on the other hand, pays lower dividend and focuses on reinvestment for growth. So they follows different paths and different goals. Introduction to capital, working capital. So what is working capital? Working capital is a lifeblood. As we are humans, we also have blood in our blood vessels. So working capital is the lifeblood of daily business operations. It's the difference between current assets and current liabilities. CA minus CL, current assets minus current liabilities. Managing it well ensures that a company can pay its bills, keep production flowing, and avoid disruptions. In short, it keeps the wheels turning. Types of working capital. So there are different type of working capital. Gross working capital, net working capital. These are the main pillar. Gross working capital refers to the total current assets, and net working capital refers to the current asset minus current liability. And there is another permanent and temporary working capital. So we can also distinguish this working capital, which is always needed, in temporary working capital, which is fluctuate business cycle. Importance of working capital management. So effective working capital management maintains liquidity, reduces financial cost, and increases profitability. It prevents operational hiccups and ensures that the company can meet some obligations without any stress. Okay, company's working capital. These are the company's working capital key components. So first component is inventory, second one is accounts receivable, third one is cash and bank balances, fourth one is account payables, and fifth one is short-term loans. Each component must be managed carefully to maintain balance and efficiency. Working capital operating cycle. What is working capital operating cycle? This operating cycle tracks the time between cash outflows and cash inflows. It includes purchase, then inventory, then sale, then receivables, then cash. These are one round, and it creates a cycle. That cycle called as operating cycle. Starts affecting working capital. Working capital needs vary based on the nature of the business, production cycle length, credit policy, seasonality, and growth rate. Understanding these factors helps to tailor the working capital strategies. Inventory management. Inventory management, uh, first one is EOQ, economic order quantity. This concept is widely used in the corporate sector for optimal stock levels. ABC analysis. ABC analysis is a technique where inventory are classified into three sections A, B, and C, where A represents the most valuable assets and C represents the most least valuable assets. Just in time. Just in time means whenever the raw material or the inventory is needed, then only the organization order that raw material or the inventory when that is needed. That is called just in time. Then safety stock and reorder level. Safety stock and reorder level, they are used in the corporate sector to avoid the shortage. Receivable management. First one is credit policy setting. So receivable management involves setting credit policy, defining the credit period and the limits, enforcing collection policies, and the using of schedules that all have a schedule. It ensures timely cash inflows and minimize the bad debts. Bad debts mean those are those debts which can't be recovered. That becomes bad debt. Cash management. After receivable management, now we have to explore cash management. Cash management focuses on budgeting, float control, and short-term investments. The goal is to maintain enough liquidity without holding ideal cash. It's a delicate balance between the safety and the profitability. Okay. Then coming up next, working capital financing. To finance working capital, companies use tools like bank overdrafts, trade credit, commercial paper, factoring, short-term loans. So these are the tools. So choosing the right mix depends on cost, flexibility, and risk. Working capital estimation. Estimating working capital involves forecasting current assets and liabilities based on sales, credit period, and inventory turnover. This helps to plan financial needs and avoid liquidity crunches. Estimation example. Here I have put one example that is called estimation example. So I need to elaborately discuss that. So, for example, if projected annual sales are 12,000 and the average collection period is 2 months, so receivables would be 2 lakh and add inventory, all the process. After that process, add inventory and subtract the payables. Okay. Importance of adequate working capital. So, too little working capital leads to liquidity issue. Too much means ideal funds and how low return. The key is to maintain an optimal level, supports operational without wasting resources. Then coming up to the next slide, CCC, cash conversion cycle. CCC measures how quickly a company convert its investment in inventory and receivables into cash. To calculate CCC, there is an formula which I have put in my slide. And a lower CCC means better efficiency and fast cash recovery. Now, CCC example. Let's say inventory period is 60 days and receivables is 30 days and payables 40 days. Then CCC become 60 plus 30 subtract by 40 equals to 50 days. This means it takes 50 days to turn investment into cash. Strategies to improve CCC. To improve CCC, companies can increase inventory turnover, tighten credit control, delay payments, and use automation and analytics. These are the strategies they can use to enhance liquidity and reduce financial needs. Real world example of working capital. Take Hindustan Unilever, HUL. So, for example, it operates with negative working capital. I assume that it operates in negative working capital using supplier credit to finance operations. These strategies work because of its strong market position and efficient cycle. Coming up to next, working capital versus liquidity. Working capital and liquidity are related, but not the same. Okay. So liquidity is the ability to meet short-term obligation, and working capital is a broader measure of short-term financial health. Both are essential for operational stability. Working capital policy. There are three working capital policy: conservative, aggressive, and moderate. Conservative, high current assets, safer but lower returns. And aggressive, low current assets, it riskier but high returns. Moderate. In that case, choosing the in that case, both are balanced. Risk and return both are balanced in moderate. So choosing the right policy depends on the company's risk risk taking ability. So let's recap the corporate finance decision, which I have already told before. First, I have told that investment decision, then their parts, then financial decision, their classification, then dividend decisions, their theories, relevant theories, irrelevant theories. So that all I have already told. Then last I have told working capital decision. Hereafter I have done. Then next come financial statement analysis. Financial statement analysis is the process of examining a company's financial report, okay, to assess its performance and stability. It helps stakeholders to make informed decision, whether it's a investing thing, lending thing, or managing operation. We look at the profitability, liquidity, and solvency to get a complete picture. Key financial statements. There are four key financial statements: balance sheet, income statement, so which is also called profit and loss statement, cash flow statement, and statement of changes in equity. So balance sheet shows assets and liabilities and equity. PL or income statement, it reveals the revenue and expenses. Cash flow statement, it tracks cash inflows and cash outflows. Then statement of changes in equity, it shows the changes in the ownership and interest. Together, they all form a backbone of financial analysis. Tools of financial analysis. So the tools of financial analysis is ratio analysis, common size statements, trend analysis, comparative analysis, and cash flow analysis. Ratio analysis for performance metrics, common size statements for comparison, trend analysis is for spot patterns, and comparative statement for the year-on-year changes. And lastly, cash flow analysis to assess liquidity. These all tools are used. Okay. So next kind of profitability ratio. Profitability ratio measures how efficiently a company generates profit. So there are four things, that EPS, ROA, ROE, and net profit margin. This helps investor to judge whether the company is worth investing or not. Liquidity ratio. Liquidity ratio assesses a company's ability to meet short-term obligation. It classified into two ratio, current ratio and quick ratio. Current ratio calculated as current asset divided by current liabilities. And quick ratio calculated as current assets minus inventory divided by current liabilities. Then solvency ratio. Solvency ratio evaluate long-term financial health, debt equity ratio, interest coverage ratio, total debt ratio. These are the classification of solvency ratio. Debt debt to equity ratio shows the leverage. Interest coverage ratio measures ability to pay interest. And total debt ratio reflects overall debt burden. These ratios are crucial for the lenders and investors for assessing risk. Efficiency ratio. So efficiency ratio are classified into inventory turnover ratio, debtors turnover ratio, total asset turnover. Higher efficiency means better resource utilization and profitability. Market value ratio. Market value ratio helps assess to performance like a PE ratio, market to book ratio, and dividend yield. These ratios are the key equity investor to evaluate the valuation and returns. Coming up next, DuPont analysis. DuPont analysis breaks down the ROE into three components. ROE equals to net profit margin multiplied by asset turnover multiplied by financial leverage. This helps to pinpoint whether profitability, efficiency, or leverage is driving returns or not, or in case a improvement is needed. So it helps to analyze that. Common size statement. Common size statement express financial items as a percentage of a base, like sales or total assets. This makes it easier to compare performance across time or between companies, regardless of size. Then comes trend analysis. Trend analysis tracks financial figures over multiple years. It helps identify to it helps to identify growth patterns, declines, or anomalies. This is a especially this is especially useful for forecasting and strategic planning. Vertical and horizontal analysis. Vertical analysis shows each item as a percentage of a base in a single year, like expenses as a percentage of sales. Horizontal analysis compares figures across years to spot growth and decline. Both methods offers valuable insights. Real financial analysis example. Here I have put a real world example of financial analysis TCS. All you guys know that Tata Consultancy Services. So I assume that net profit margin of TCS is around 20%, strong ROE. So it means strong ROE and low debt. It indicates profitable and stable firm with efficient operations and low financial risk, making it attractive for the investor to invest. Introduction to corporate governance. Corporate governance is a system of rules, practices, and processes by which a company is directed and controlled. It ensures that decisions are made in the best interest of shareholders, especially for the stakeholders. Good governance builds trust, promotes transparency, and protects the long term value of the firm. Principles of good governance. The foundation of good government rests on five key principles. Here are the five key principles: fairness, accountability, responsibility, transparency, and ethics. Fairness in treatment of all stakeholders. This principle is much needed. Accountability for decisions and actions is much needed. Responsibility in managing resources is much needed. Transparency in operation and reporting is much needed. And uh, lastly, ethics. It's also needed, which guide the behavior beyond legal compliance. Together, these principles create a culture of integrity and performance within an organization. Role of board of directors. The board of directors plays a central role in governance. Their responsibilities include providing strategic oversight, evaluating management performance, managing risk, and protecting shareholders' interest. A strong board ensures that the company stays on course and acts responsibly. Corporate governance in India. So, in India, corporate governance is regulated by SEBI. SEBI full from Security Exchange Board of India. So it is regulated by SEBI through the LODR regulations. Earlier, Clause 49 of the listening agreement laid the foundation. Today, listed in the companies must follow strict disclosure norms, appoint independent directors, and maintain a transparency in operation. This is legal compliant in the corporate sector. Role of Security Exchange Board of India in governance. SEBI plays a vital role in enforcing governance standards. It protects the investors' interest, mandates the independent directors, regulates insider trading, and promotes corporate discipline. SEBI's regulations ensure that companies operate fairly and ethically in the market. Ethics in finance. Ethics in finance means acting with the integrity, treating stakeholders fairly, and avoiding fraud, manipulation, or avoid insider trading. Ethics behavior builds investor trust and it strengthens the company's reputation in the market. Real life ethical failure examples, Raktim scam. Here I have put one example, real world, that we are gonna explore, Satyam scam. Satyam scam is a stark reminder of what happens when government fails. Company inflated profits and assets, and the board fails to act. This lead to one of the India's biggest corporate fraud and triggered the stricter laws and reforms of government's practices. This is whole story about the Satyam scam. Now, case study of capital budgeting, Apple Inc. Let's begin with Apple Inc. Okay, Apple invested heavily in the new product lines like in iPhone, Apple Watch, using capital budgeting techniques such as NPV and IRR. These tools help them, these tools help Apple company to evaluate long-term returns and risk. And what is the result? High ROI, high return on investment, and global dominance. This case shows how strategic investment decision can transform a company. With the structured Tata Motors. Tata Motors used a balanced mix of debt and equity to fund its expansion. So by managing its cost of capital effectively, the company maintained a long-term solvency and financial flexibility. This case strongly highlights the importance of choosing the right capital structure to support growth while minimizing the risk at the same time. Dividend policy Infosys. Infosys is known for its stable and consistent dividend payouts. This approach builds investor confidence and supports long-term growth. At the same time, Infosys retain enough earnings to invest their innovation in the R&D team. So as a result, a well-crafted dividend policy can ally with the shareholder satisfaction with strategic goal at the same time. Now, case study working capital HUL, Hindustan Unilever Limited. Hindustan Unilever operates with a negative working capital, using supplier credit to finance operations. This strategy reduces the need for external funding and improves efficiency. It's a great example of how working capital management can be drive operational excellence. Case study financial failure Jet Airways. Jet Airways is a cautionary tale. Poor capital structure, mismanagement working capital, and excessive debt lead to insolvency. This case underscores the importance of financial discipline and strategic planning. Even a market leader can fall without sound financial management. Coming up next, Reliance industry case study. project financing. Reliance Industry funded large refinery projects using a blended debt equity strategy. They are focused on minimizing WACC and maximizing the long-term returns, help them to scale efficiently. This case illustrates how project financing can be supports ambitious growth while maintaining the financial health. So here are the takeaways from the case studies. So what do these case studies teach us? A balanced capital structure crucial for stability. Dividend policy should ally with the company strategy. Efficient working capital management guides operations. Ethical government prevents corporate failure. Real world example, what I have told, it bring corporate finance to life and shows how theory translates into real world practical example. Recap the corporate finance concept. So investment decision, capital budgeting. So where we should invest for long-term growth. It told that financial decision, how do we fund those investment, debt, equity or mix. It, this section told that dividend decision. This section told how do we balance shareholders payouts with reinvestment. Working capital. This section told us that how do we manage day-to-day operation efficiently. Now formula summary. Here are the formula, NPV formula summary for recap. PV inflow minus PV outflow. IRR, rate at which NPV becomes zero. WACC, as you can see, guys. Then DOL formula is percentage change in EBIT divided by percentage change in sales. Financial leverage, DFL uh, formula is percentage change in EPS divided by percentage change in EBIT. And here is the ARR formula again, then payback period formula, then current ratio formula, then quick ratio formula, then get to equity ratio formula. You guys can take this screenshot. Then practical tips from my side. Always consider time value of money in your investment decision. And before taking any investment decision, please assess the risk associated with the returns. And here is a second tip from my side. Please use leverage casually, like the right proportion of financial leverage and operational leverage. And adhere the dividend policy based on the company's growth. Now I have put one visual. These visuals capital structure graphs, NPV profile, EBIT, EPS chart. So it helps to reinforce the concept we have discussed. They turn into theory and insights. Visual of NPV profile graph. Here is a visual, as you can see, guys. Then EBIT, EPS graph. Then working capital cycle here. First cash converted uh, from cash we use it in the production, then we sell that, and then we purchase from that cash we purchase inventory. This is a DuPont analysis chart. This is a dividend policy comparison. Emerging trend in corporate finance. Corporate finance is evolving. Fintech is transforming advisory services like robo advisors, AI. ESG investing is reshaping the priorities like an ESG full term is environmental, social, and governance. Blockchain is enhancing transparency. Digital banking is uh, it's streaming the liquidity management. Real world application example. Companies are already apply these innovations. AI for capital budgeting projection, blockchain in supply chain financing, data-driven working capital optimization. Corporate finance is no longer just about numbers. It's about strategy, technology, and vision. Corporate finance challenges. So challenges in every sector, challenges remain. So in the sector of corporate finance, there are those challenges present like market volatility, economic uncertainty, regulatory changes, managing risk with the limited capital, aligning the strategy with shareholders' expectation. But with strong fundamental and ethical leadership, these challenges can be mitigated. Then summary of corporate finance framework: investment, then financing, then dividend, then working capital, then governments. Tools like NPV, IRR, WSCC, and the leverage helps us to navigate this framework. This ultimate aim. What is the ultimate aim for that? To maximize the shareholders' wealth. Key formula recap. Then these are the yeah, these are the tools. So just to once again recap the formulas. Then ethical consideration. Finance is not just about profits, it's about principles. What is that principles? Integrity in reporting, fair treatment for stakeholders, avoiding fraud and insider trading. Six builds trust, and trust builds value. Real life ethical failures example, Satyam. So, as I already discussed, a Satyam scam, what is that? The Satyam scandal reminds us what is the stake: inflated profits, fraud, negligence, and lack of oversights lead to collapse. It's a lesson in why government's ethics must never be compromised. Recap the learnings. Corporate finance is a balance of risk and return and liquidity. With proper planning and analysis, we can enhance firms' value. Ethical government ensures sustainable growth, and case studies shows us how theory become practical. Visual corporate finance flow. Here, the flow chart it's all together from investment decision to government. It's a roadmap for strategic financial management, investment, then financing, then dividend, then working capital. In the reference tab, I have mentioned the sites from where I have taken the uh, case studies or the materials which I have used in my slides. So conclusion at the end, I have to say that corporate finance is the backbone of the strategic business decisions. The special reminder is invest wisely, guys, manage risk, and follow ethics. Thank you.